1310 WIBA and Ask the Experts, brought to you by Wisconsin Capital Management, online, wiscap.com. That's WISCAP.com. If you haven't had a chance yet to check out the website, it's a great day to do that. A lot of great information about Wisconsin Capital Management. You can learn about their history, learn a little bit about what they can do for you. You can also set up an appointment. Again, all those details right online at wiscap.com. Joining us this morning from Wisconsin Capital Management, of course, we've got Tom Plum, financial planner with Wisconsin Capital Management. Nathan Plum, certified trust financial advisor, is executive MBA. Tom, how you doing this week?
Well, we're doing just great. It's a beautiful day in Wisconsin, and it's a touch of autumn every day, but it's beautiful weather.
It is a great time of the year, that is for sure. Nathan, how have you been?
Doing fantastic. Just happy to be working, and again, enjoying this beautiful weather.
It is, it's a great time of year, that is for sure. And we've got, speaking of seasonal things that are important and things that kind of change with the months, and that, of course, is interest rates. And we've got a really interesting conversation ahead about the Federal Reserve Bank and other things. Real quick, before we get to this week's new topic, let's take a look back, Tom. Some of the stuff we've covered in the past. I mean, we've covered a lot of ground on this program, haven't we?
Well, yeah, we have, Sean. We talked about interest rates. We talked about present value growth and stock market, the economy. We've talked about how it applies to individuals with their planning and how they plan for retirement, what they do as they approach retirement and after retirement. But today, interest rates going to be a good subject because last week today is September 23rd, 2025, and last week the Federal Reserve Bank lowered interest rates by 0.25% in their appointment and their announcements.
What is this? And Tom, let's kind of, for people that don't know, this does have, as you kind of alluded to there, this can have pretty significant implications across all aspects of life, markets, and not just interest rates in general.
Oh, yeah. The interest rates are a big thing that affects the present value of any project that you have, the cost of having a house, costs of doing business, especially small companies, which often rely on bank loans or loans from some entity for their working capital or for their basically the equipment that they may buy and things like that.
And so, Nathan, we'll bring you in on this conversation as well as we talk about the Fed and interest rates. People need to understand interest rates can be quite different depending on the type of borrowing, the person, the borrower, their history. There's a lot of factors to this. This is a pretty widespread part of the conversation, isn't it?
That's true. Not all interest rates are the same. Rates depend on whether you are a borrower or a saver, depend on your credit rating, depending on your length of time that you're to take a loan. And, generally, there's things that have different sentiment. So if you're taking a shorter loan, you're usually taking less risk. And if you're taking a longer loan, you're taking more risk. Then the other factor is your credit rating, or essentially your ability, they think you're going to be able to pay it back, you pay your loan back. So, for example, just now the short-term Treasury rates are just down 1% lower this year, and as opposed to the 10-year Treasury, which is actually up this year. So, again, both the time and your credit worthiness are big factors in interest rates.
And we'll talk a little bit too about the Fed in just a moment as well, and what that is exactly and how that affects this stuff. And Nathan, as we talk about just about interest rates as well, you mentioned some of the different factors. These are things too as general consumers we need to think about business as well as Wall Street. They really do watch what the Fed says, what they signal, what they ultimately do. They watch this stuff quite closely, don't they, Nathan?
That's true. I guess one thing you can remember is that interest rates are the heartbeat of the American economy. So if you speed it up, or you can slow it down, and then everything else will follow. So speed it up as in lower rates, and slow it down as in raise rates. So it sets the pulse to the entire U.S. economy. Last Wednesday, Chairman Powell of the Fed Reserve Board met, and you might have heard that he lowered the discount rate for 25 basis points, or 0.25%. And then he was asked a ton of questions about what he sees in the future of the economy. And everyone in Wall Street and Main Street watches every word very, very carefully and with almost an amazing reverence. And they try to glean into what the future of the economy holds.
Talking this morning with Nathan and Tom Plum of Wisconsin Capital Management. Online, the website, wiscap.com. That's WISCAP.com. A really nice website, really user-friendly, a lot of great information about Wisconsin Capital Management, and you can head on over there. Again, that's wiscap.com. Great opportunity also, if you've been listening to this program, you'd be interested not only to learn more, but actually sit down, have a conversation. You can schedule an appointment at wiscap.com. That's WISCAP.com. And Tom, let's talk then about the relationship between interest rates and kind of understanding how this big machine kind of boils down to day-to-day practicality, day-to-day life, and what exactly is the quote-unquote Fed? What are we talking about there?
So, Sean, we talk about the Federal Reserve Bank, and they are the bank of the banks, basically. And they set policy, as Nate said, that determines whether or not they want to be accommodative to economic growth or they want to be restrictive. They get restrictive when they're concerned about inflation. They get accommodative when they're concerned about unemployment. And then often they're what they call neutral, where they are in between. So this, what they do is they actually set a rate that's called the discount rate. And that's the rate that the Federal Reserve Bank can lend overnight to different banks. And from that, a lot of other relationships are impacted. So the banks lend to each other, and they call that the federal funds rate. And that is keyed off of what this discount rate is, because that's the indication of the policy and the cost and alternative that banks have when they're borrowing money overnight. And then when you look at, for most of us, we recall what they call the prime rate, and that typically is based off of the federal funds rate. It's a spread that the banks determine they're comfortable with in lending to you and I when they know what their costs of funds could be from the Federal Reserve Bank. So a lot of local small businesses, their loans are often tied to what's the prime rate, and they can go up or down when you have loans that are for inventory or working capital, things like that. But as Nate mentioned, time is also a big factor, because when you have a short-term loan, it's usually tied up with short-term assets. But when you start looking at lending money to a bank, from a bank to a company, they're going to be borrowing money not only for working capital, but also for equipment and things, maybe even buildings. Those are longer term, and there's going to be a spread that's going to be involved there. So you may find out that banks and interest rates can be affecting each one of you a little different. We call the difference between the short-term rates and the longer-term rates the yield curve. And that's a term that we mean where we discuss, for example, short-term rates or 2-year rates from the Treasury to the 20-year, 30-year rates that, and even the 10-year rate, which often is the basis for a lot of mortgage, fixed rate mortgages being set.
You know, Tom, one of the things I remember years ago, it kind of, I don't know, it kind of like dawned on me. I always was under the impression, I think a lot of folks may be under this impression that like when the Fed adjusts rates, that automatically affects it like a 1-for-1 of interest rates, and it's not that simple. At like as a consumer, as a borrower, it's not a 1-to-1 type thing. There are, as you just point out, obviously with the yield curve and the terms of rates and other factors, it's a very complicated formula behind the scenes, isn't it?
Oh, and it's all based on supply and demand and confidence. So you have to have a certain confidence in what the cost of money is going to be for you next day, next week, and also in the future. So you want, as Nate said, a higher spread if you're committed to lending money at a fixed rate for a longer period of time, because more things can happen over time. So you may end up finding that typically, if everything else was the same, that rates would go up the longer term that you locked in. So a 30-year mortgage in most years, we call that a normal yield curve, would have a higher rate than a short-term rate or a variable rate because banks then don't have to worry about the interest rate risk, but they are worried about the credit risk. And credit can change, as some of the companies that we've seen and some of the people we've known have been very, very wealthy at different times and seemed like they were golden credits. But time can change that.
Do businesses have credit scores, Tom? I've never thought about this. As an individual, I have a credit score. Or is it different, or how do you know how do they know as far as credit worthiness of a business or institution? How does that, do they have like a score or rating on that, or how does that go?
Well, they do. Certainly the banks and the regulatory agencies all have a scoring for different types of loans and different types of coverage on those loans. So what we call that multiple of the coverage ratio, what's their consistent cash flow versus what their debt expense is. And there's different ways they look at what they call current ratio of your short-term assets versus your long-term assets, because there's always been cases where companies have had a lot of assets, but they didn't have liquidity and they weren't able to meet their short-term obligations. That's one way that some companies can really get into trouble.
Talking this morning with Chartered Financial Analyst Tom Plum and Nathan Plum, Certified Trust Financial Advisor, Executive MBA with Wisconsin Capital Management. You can learn more about them online. Great website, wiscap.com. That's WISCAP.com, all one word, WISCAP.com. From the website, you can learn more about Tom and Nathan, the whole team at Wisconsin Capital Management. You can learn a little bit about how they operate, what they can do for you. And, of course, we talked this morning about the Fed and other great information. Don't forget, we've done a lot of great shows, a lot of fantastic podcasts out there. Of course, you can access those as well from wiscap.com. We're going to continue our conversation with Tom and Nathan. We'll talk about mortgage rates, which is, when it comes to interest rates, probably for most individuals, one of those biggest questions they ever have is about mortgage rates. We'll get some details from Nathan on that, and we'll talk with Tom, too, a little bit more about Wisconsin Capital Management. We'll do that next as Ask the Experts with Wisconsin Capital Management continues right here on 1310 WIBA. 1310 WIBA and Ask the Experts with Wisconsin Capital Management. The website, wiscap.com. That's WISCAP.com. Fantastic website to learn more about Wisconsin Capital Management. Again, that's wiscap.com. Talking this morning with Tom and Nathan Plum of Wisconsin Capital Management. I'm going to talk a little bit more about the Fed. We're going to talk a little bit more about interest rates. Specifically, we're going to get into mortgages with Nathan in just a moment. But first, Tom, real quick, let's talk about Wisconsin Capital Management. It's a fascinating story about how we got to where we are today, and the work that you've done to create and keep Wisconsin Capital Management out there for folks. It's a really amazing backstory. Let's talk a little bit about how this all got started and what you guys are doing for folks today.
So Wisconsin Capital Management's foundation was basically a group of us. We're at a trust company locally in Madison, Wisconsin, running the trust investments, including stock funds and bond funds. And one of my earliest things to do was to manage the bond funds, where people who wanted to be invested in fixed income would have the bank provide investment services to foundations, retirement accounts, and individuals. So I learned a lot about the different things that could affect the risk and return in the fixed income area. I recall once looking back, the Wall Street Journal used to, on the first business day of every year, publish a forecast of the leading economists about what they thought was going to happen to interest rates that year.
Mm.
And what we found is that I think the first 20 years that they did that, 18 years, not only was the consensus way off and wrong, but they were at least 17 of those years even wrong about the direction of interest rates for the year. So it gave us a very healthy cynicism when we listened to economists and forecasters about the direction of interest rates. The one thing we did find is an old adage has still remained true, which is called "don't fight the Fed." So when they've actually come out like they did last week and indicate that their perception is that they're going to be in a lowering interest rate environment for the foreseeable future, take them as a fact. Until they're proven wrong, assume that they're going to be trying to push down interest rates and trying to stimulate the economy for the foreseeable future.
Don't fight the Fed. Words to live by. Fantastic stuff this morning as we talk with chartered financial analyst Tom Plum and Nathan Plum, certified trust financial advisor, executive MBA, of course, with Wisconsin Capital Management. The website, wiscap.com. That's WISCAP.com. Talking with Tom and Nathan this week about the Fed and the Federal Reserve Bank and what it does, what effect changes as far as their rate has on the overall economy. And I think, Nathan, for a lot of us on the personal side, mortgages come into play here. Let's talk about mortgage rates and kind of understanding how they operate and really what that means when it comes to the Federal Reserve Bank and kind of on both the macro and the micro level here.
Yeah, that's great. Let's cater to the people that are looking for houses right now.
Yeah.
So the 30-year fixed rate in home mortgages is, if you want to kind of track it, the thing you should be tracking that be parallel to it is called the 10-year Treasury rate.
Oh.
So as the Fed does much more of the short-term side of the cycle, mortgages last longer, right? And so the proxy that you should use is a little bit longer than that. The one that you should probably use is the 10-year Treasury rate, not the 30-year, not the 20-year, but the 10 years probably your best bet, and it's the most traded. So if you're looking at buying a house, you have good news for you. The interest rates are actually down about 1% during the year. So if that was a key impasse to you, that's some good news for you. And then, the housing rates are expected to come down a little bit more. So if you have a variable rate, you should be happy with that. And as some interest rates go down, usually that's when people start fighting over houses and the demand, and you start getting those bidding wars. We haven't seen that in a while, so this might be a time to buy. So even though interest rates are a little bit higher than they were a few years ago.
Just some of this too, as we talk, Nathan, about the Fed and indicate kind of lowering rates. It almost, some of this stuff feels like an old steam engine, like an old train, where they're shoveling coal and it's not immediate, but as the coal gets in and the boiler heats up, those pistons start going, the train starts building speed and getting going. Is that some of what the Fed's trying to do, is kind of manage that speed with shoveling the coal in or maybe holding off? And we may not see immediate, we're not going to see immediate acceleration, maybe not see immediate deceleration, but really trying to manage almost with like a ghost hand kind of stuff from afar. Is that kind of a way to think of some of this stuff as well?
Yeah, you're definitely true. So it's not an immediate effect what the Fed is doing. So when you're hearing the Fed speak, or Congress put in a new plan or something like that for the economy, it's going to take probably at least 9 months for you start to see anything that's going to happen. So as you said, loading the coal into the steam engine, it takes a while to rev that train up. So so anything that someone does now in the economy, at the earliest, you'll see it probably 9 months from now. So if you're a politician and want to get reelected, it's good to try to do your economic boosting plan at least a year before you get reelected.
Good advice, good guidance, and I know if anybody's looking to run for office, know a guy who might be able to help you out. Real quick too, Nathan, before we wrap up this week, with those lower interest rates and what the Fed is kind of indicating there, that has an effect on things like the employment environment and other areas as well. Let's talk about get into that when it comes to things like mortgages, refinancing options, and kind of where we are overall in that area, in that walk of life.
Yeah, so when you have a mortgage, the rule of thumb that you should kind of look for is that if the current rate is 0.5% lower than what you're paying now, you should really go to either your local credit union or local bank and see if you can get refinanced, because usually there's going to be some fees involved, and that's usually kind of the proxy that you use. So if your current interest rates are lower or 0.5% lower than you're paying now, yeah, you should be proactive and do it, because the bank or credit union is not going to call you to let you know.
Yeah, and with this too, Nathan, I was going to ask, and Tom, I'm going to ask you the same question. With as you guys are helping folks at Wisconsin Capital Management, obviously, I think a lot of folks think of building nest eggs towards retirement, and of course, once you're in retirement, making sure you preserve that as much as possible and still being able to live the life as you like. For a lot of folks, you think of things like mortgages and other things. These are pretty big life decisions, and Tom, that's a really big part of kind of the overall financial picture, isn't it?
Well, when you look at your financial position, you do want to make sure that you're anticipating what's logical and how it fits in with your own lifestyle. So when we talk about interest rates, we want to make sure that those rates will be enough to help us offset some inflation. That's typically why we end up having some stocks or some equities in investments, because those are a better hedge against inflation. But as you work through all of your different financial issues, all of the different considerations, it's really good to work with someone, and we hope that Wisconsin Capital Management fits into that, who can actually talk to you a little bit about the environment we're in and the environment we expect to see and how it might affect you in the future.
Great stuff this week, as always. Nathan, Tom, great talking with both of you. You guys have a fantastic day, and I hope folks got a lot of great information. I hope folks head on over to wiscap.com. That's WISCAP.com. Tom, thank you so much for joining us this morning.
It's always great to talk to you, Sean. Thank you very much.
Nathan, it's always great to talk with you as well. You enjoy this beautiful day.
All right. Have a great afternoon, everyone.
And of course, Tom and Nate come to us from Wisconsin Capital Management. Again, that website, wiscap.com. That's WISCAP.com. News comes your way next right here on 1310 WIBA.